Let's welcome in our market master, Taher Badshah, CIO, Invesco Mutual Fund. Taher, good to have you with us here. Thanks very much. Good morning. What's worrying the market at the margin, Taher?
Well, so as expected, actually, Prashant, we are walking into that phase of higher volatility, and probably, after a long time, we are going to see multiple events which are going to be lined up over the next 4 to 6 months, and all of them in one way or the other probably are important, whether it be in the form of local elections or whether it be policy thereafter, monsoons, US elections to contend with, and of course, we are still not settled as far as the interest rate inflation debate is concerned, and that probably also will be important towards the end of the year. So I think we are clearly going to be in a phase of somewhat high volatility, and probably markets will be a little more defensive in its approach.
Markets will be a little defensive in its approach. Got it. Taher, hi, good morning. I think there are election jitters on everyone's mind, right? People perhaps believe that maybe the incumbent government may not be able to get the kind of seats that perhaps they were expecting to. At least that is the fear in the market right now. How legitimate do you think that fear is? And if it does play out in that sense, where the number of seats don't hit 400 as perhaps is the expectation, then do you see a big market fall? If that market fall happens, would you suggest buying into it? I mean, what do you see the trajectory to be for the next couple of months?
Yeah, so like as I said, I'm no political expert, but obviously in the mind of the market, there has been an elevated expectation. And I think irrespective of whatever the outcome would have been, probably I would have thought that there would have been a correction, whether it would have been a sell on news or probably some kind of disappointment in terms of the outcome for the incumbent government. So I think both ways there was, going to be a correction in my view. But I think, the market, Sonia, is very strongly focused on an expectation of 15% compounded earnings over the next 2 years at the broad corporate level, large caps within which might do probably somewhere between 11 and 13%, and mid and small caps probably might track something between 16 and 20. And you get a blended 15. So I think for the market as such, I think it'll be important to see whether there are factors which can detract from this 15% number. So long as that visibility of that 15% is by and large visible or available, I think to that extent the market should probably hold up. You will probably see corrections along the way, modest ones which come as a result of one or two of these events probably not going the way we expected to. But for deeper cuts to happen in the market, I think market has to kind of reconcile to the fact that that 15% number is at risk, and that will take multitude of factors to probably happen.
All right, I just hold on to that thought. We have a con call that's underway on REC, and they're commenting on RBI's project finance draft. They're saying that RBI's draft guidelines not applicable to loans guaranteed by the government. They also go on to say that many of their loans are supported by state government guarantees. And there's one more flash that should come up for you on the screen. They say they're not going to see any adverse impact due to RBI's draft paper with regard to project financing. Explains why the stock has seen a bit of a bounce. Last few sessions it's taken a knock. I think DAM Capital is hosting that call with the REC management. For the time being, the stock has seen a good bounce on this commentary that's coming in, on that con call. Abhishek will join us shortly as well to run us through an impact on this. But for the time being, a bit of a relief rally is what we are seeing. Well, hi, Taher. Good morning and good to see you. Well, let's keep elections aside. How are you positioned on FMCG stocks? Out of nowhere, you saw some positive commentary coming in there. And now the street is coming to terms that maybe FY25 is not going to be as bad as earlier thought. Also, there's a bit of an under-ownership that's playing out in some of these stocks. Your view and how you're placed out there?
So Nigel, we not necessarily only FMCG, but by and large, I think we generally our approach is to kind of try and keep a little bit of balance as far as the portfolios are concerned. For example, even in very strongly growth-oriented strategies, we do have a smattering of value in our portfolios. And I think I would have spoken earlier, even on the show, that probably there is value in some of these value consumption pockets, which have not probably done well in the course of the last 2.5 years, given what's been happening to the lower end of the income pyramid as well as in the rural markets. We are seeing, obviously, there being some triggers not fully established, but some reasons to probably try and expect an uptick as far as volume growth and a recovery in that segment is concerned. So I think we have been taking some modest positions out there. Since, like as I said, we don't have full evidence, so we don't have a choice but to kind of wait for some more evidence to come through in the form of numbers, quarterly performance, volume growth, etc. But clearly, I mean, there is an initial case to have some foot in the door as far as some of these segments are concerned, which have turned value in the course of the last 2 years.
Okay. I wanted your thoughts on some of these consumption pockets, which are big beneficiaries of, say, premiumization, right? We've seen them in the auto space with names like M&M. We've seen them in the alco beverage space with names like Radico Khaitan, etc., United Breweries. In real estate, a lot of premium projects are selling now. Do you think this premiumization theme is something that can continue? And if yes, which are the pockets where you still see some valuation headroom here?
So unfortunately, on your second question, there's pretty much no valuation headroom which is available out here. But the point is that this is still a reasonably structural theme, and I think this is something which has probably got a little more credibility to it, probably compared to, as things stand at least today, compared to, let's say, the revival at the lower end of the market. I mean, if on a 2-3 year scale, I think it is a lot more easier to expect that premiumization and growth in those particular segments, whether it be retail or whether it be in automobiles or a few other sectors, is far more easier to expect and reconcile with. On the lower end of the income segment, and particularly rural revival, it will take a fair bit of effort, not just only monsoons, but probably even in terms of policy and a few other things to actually come together for that recovery to kind of take legs. So I think premiumization as a story continues in my view. Of course, they are not probably, I mean, you may not have valuations which are on your side of the stage, but if you were to probably get some of those corrections, which are quite likely from a rotational perspective, I think those are themes which may still excite us.
Right. Taher, we just heard that comment from REC, right? Financiers, really, what's your view? Do you own some of these names, especially on the power financing side?
Yes, a fair bit. I mean, we have been owners. Some of these stocks have done exceedingly well. So, over the last 1 year or so, I think most of the investors who have come in at various stages would have probably made some kind of money or the other. But obviously, we've seen the regulator being very vigilant about every pocket, and it was initially supposed to be only on the personal loans and on the consumer loans segment.
Taher, how would you read the comment from that con call? I mean, if I can ask you that, since you have exposure, so you'd kind of know. They're saying that government guaranteed loans, this does not, that one flash which came, the standard asset provisioning going up to 5%, it doesn't apply to government guaranteed loans. Basically, there was another general comment saying that there won't be that much of an impact. We had Nikhil from Bernstein earlier, the analyst, who said, this perhaps means that if you sort of work it back and look at interest rates and how much they need to go up by to compensate for this increase in provisioning, it's about 30 basis points, basically. Just your thoughts, Taher.
So I think it probably, at least from the comments, it appears to be a little less, punitive compared to what was feared initially. And to that extent, it may not be as harmful. But the thing is that, it just, at some level, the market will now keep this in the back of its mind that, there would always be some regulatory, pressures which will come along the way, especially if some of these segments continue to show very strong growth. So I think may not necessarily impact as much in terms of book value compounding or probably growth in earnings. But clearly there will be some capping of upside as far as valuations is concerned. That's the easiest conclusion that we can probably make at this stage.
Yeah, no, absolutely got that. There's one view that look at all of these regulations, etc., from the RBI, and maybe they just want, the credit growth to maybe come off a little bit, right? It's been running red hot in some segments, especially, and not exactly a bad thing. On the capital market side, Taher, are you worried that we may eventually see some regulations, etc.? Because we've heard a worry being expressed by the regulator on that side, on the futures and options side. And that has really been a big driver for growth. Just wanted your thoughts. We had a fund manager earlier, 2 days back, who was pointing that out, that that remains a big risk for some of these stocks.
So, Prashant, it remains an outside risk, and that's something which we keep in mind, at least in terms of the way we size our position in some of these names as far as our portfolios is concerned. We still are reasonably confident about the growth trajectory of some of these enterprises, and that at least is supportive as far as those capital market stories are concerned. But we can't take away the fact that this is an outside possibility. However, some of the recent moves by the regulator probably don't seem to suggest that they want to go all the way down to really taking a very hard call on curbing volumes, etc. So it's that's where it is. I mean, this can obviously change. That position can change tomorrow, but at least from
Correct.
some of the recent regulatory changes, doesn't seem to suggest that they want to go all the way down.
Okay, we leave it at that. Taher, thanks a lot for joining in. Appreciate your time here. By the